Entrepreneurship
on 702.
Andisa Ramavhunga, Group Chief Advisor at Ntiyiso Consulting Group, is my guest. We talk about that income statement. What is it? Please join us in this conversation. 011-883-0702 as we have this conversation around the income statement. Andisa, thank you so much, my brother, for joining me. I really, really appreciate your time.
Thank you, Aubrey. It's always great to be here.
So you gotta know about some of the feedback that I'm getting from people who are listening to this conversation. One young person said to me, Bra Ops, I'm beginning to understand the value in understanding technical detail. And he said that I wish that I had been brought up understanding that value, because that is what I think we lack. We understand big picture, we understand bigger principles, but what we lack as South Africans, and I suppose it was a generalized conversation, so take it from where it came, was that we lack an affinity for detail and technicality. And that is something I would like your thoughts on.
Yeah, that's true. I think you've just given me the definition of a strategist. I know a lot of people, when you talk strategy and strategists, they always think, oh, they are these big picture people, and they are able to look at the forest without appreciating the trees. That's very further from the truth. I think a good strategist has got a very good grasp of every moving parts. They are systems thinkers. And not only do they think about the whole system as it works, but they're able to zoom into the components of the system and understand the subtle nuances of what drives that particular system. And that's what strategy is. I cannot emphasize or overemphasize the notion that says it's great to be big picture people, because it always keeps you honest and it always keeps you looking forward, right? But without you understanding the underlying details, you are building your vision on quicksand. Yeah. There's no depth and there's no foundation. So it's very important. And these conversations we are having, Aubrey, and you'll see that we've been oscillating as well, right? From big picture thinking to very much detail, to sometimes elements of business spirituality, because that's what I view as money. Yeah. And to some of the concepts of what makes a business tick. I've been at point, I think, when speaking to you, to saying that the true test of whether we are, this segment particularly, whether we are doing it well or not, is trying to demystify what I call the science of business, because that's what it really is. We have broken down business into its constituencies, right, into its relevant, and we've tackled each and every element with the limited time that we've had, trying to give people the appreciation of what each and every component is about. But we quickly come back and piece it together and show the big picture.
So I want to go into a component of the big picture. We've spoken, as I've already laid out in my introduction, about many aspects, but all of them seem to be connected to the idea of value. More and more as I think about this, as I meditate upon the conversations we have, I realize that until we as entrepreneurs understand the concept of value, yes, and everything else, all of the appendages that allow us to realize it, then we are playing games. Yeah. But tonight we want to talk specifically about the issue of the income statement. What is that?
Yeah, so I think, again, let's put it in context. This is, again, one but of many conversations we've been having in a series. We started opening the conversation about value itself, which was a strategy and how a strategy creates value. And we spoke about three concepts about product and your business. And those three concepts are whether your business or product is desirable, and you started speaking for it. Are you creating a need, or are you fulfilling a service for a segment of the population? We then came back to the feasibility element that says, do you have what it takes, or do you understand the work that needs to be done in order to deliver that value proposition to that segment of the population? And finally, we spoke viability, which is, can you make money sustainably? And we obviously took a diversion a bit. We spoke about what sort of organization you need to design. And that's when we spoke about culture. We spoke about processes. We spoke about the organizational architecture. And all those are pinned into what I call the nuts and bolts of the business or the strategy, which is around organizational design as well as strategy. And I think we delved as well into leadership and culture, which are intertwined. And we started a fascinating component around how do you measure whether you are doing in the strategy point of view or in the organization point of view, whether you are winning or not, whether you are creating value or not. And we came back to say that the financials are the scoreboard of how you judge whether you are doing well or not. And we started with a very important concept of a balance sheet. And we simplified it again to say a balance sheet simply means, do you have assets? And it goes on further to say, how are those assets funded? Are you owing them or are they created out of your own sweat, which we called equity? That was a departure in point where we said that's the value, because every business ultimately is measured using a balance sheet, because a balance sheet, I call it a store of value. It's a snapshot. It's almost like a DNA as you transverse through the journey of business as to what sort of...
It's the architecture.
Yeah.
Of your business.
Of your business,
right.
Yeah. So it will tell you everything about your financing decisions, your operating decisions, your investment decisions. And I say investment because the asset side, if you have a business with a bigger asset, it means you've been aggressive in acquiring the assets. The financing tells you whether you've been going out to get equity or you've been going out to get debt. The operating decisions shows you how well you've been growing that equity component, which grows the overall balance sheet. So we went into not too much detail, but I thought we gave it enough short. I guess what we're defining today is how to grow the balance sheet, which is a function of the income statement. I said the balance sheet is a store of value, but how you increase or how you create the value, you measure that using the income statement. So simply the income statement is an account over a period of time of how a business made money and how it spent that money and whether it left a surplus or not. And that surplus is the one that you take back to the balance sheet to grow it. So that's the simple definition of what I call a balance sheet. But obviously it's got a science to it, and that's what I hope we'll unpack in our conversations today.
011-883-0702 as I speak to my guest, Andisa Ramavhunga, Group Chief Advisor at Ntiyiso Consulting Group. We're talking about the income statement, its relationship to the balance sheet.
Yeah.
That's very, very important, folks, for us to understand that. The relationship between the balance sheet and the income statement. I'm still getting my mind around it. I hope that you're getting your mind around it, and I'd love to take your insights as we demystify the science of business. Yeah? Because I think what we're doing in this conversation, Andisa, is that we are getting ourselves more and more comfortable with the technical and detail of business. Because as my young friend who spoke to me about our conversation was saying, he said, that's our fundamental problem. Yeah. Well, we were speaking about himself and those he identifies with. He said, our fundamental problem is that we are afraid. We have an aversion. We feel unqualified to have the technical, detailed conversation. And what this conversation that I'm having with Andisa Ramavhunga and yourselves is about breaking down that wall of feeling like we're imposters in the conversation. Yeah? Yeah. We want to dissolve that wall and really get into a situation where we are comfortable with the detail, the science, and the technicality of business. Otherwise, folks, let me stand up as I say this. Otherwise, we cannot be part of the next phase of the growth of the global economy. We can't. It's just going to be absolutely impossible. Yeah? And we can sit down and we can argue and complain about, but the fact of the matter is that we've got to get comfortable with the detail, with the technicality and the science of business. That's what's going to earn us a place in the future. Okay. Let's just break it down again for me. Because you got to be slow now.
I will be
Very slow.
Very slow.
There is the balance sheet and there is the income statement. Both of these documents are measurers of the value of the business at one given stage of the business. Would that be correct?
At the same stage of the business. All of them are taken at a particular point in time. It's a snapshot. So one tells you basically how the business was running in a year, and which is the income statement. And the balance sheet tells you the position, which would be the accumulated value over the years, by the way, at that point in time. Right. If you've been accumulating assets over the years, those assets, whether they were done in year 1, year 2, year 3, you account for them at that point in time. So hence, that's why the balance sheet is, I would argue, the most important statement of the business, because it tells you the history. You mentioned it the other day that it's like an ID number. It tells you the race of the business. It tells you how old. It tells you whether it's male or female. The balance sheet provides exactly that. Okay. Exactly that.
But all of these documents are about the operations of the business over time.
Yeah. So the balance sheet definitely over time. The income statement is over a 1-year period.
Right.
Yeah.
But fundamentally, both of them talk about a particular unit of time. It could be 3 years, it could be a year.
So look at it this way. If let's say a business is 5 years old.
Yeah.
At year 5, when they publish their financial statements, the balance sheet will tell you every value or every debt or every little bit of equity that has been accumulated over the 5 years. The income statement will only tell you what happened from year 4 to year 5. But I mentioned this thing that and this is the very interesting component of the income statement, because again, I simplify. You've got what we call net income of the business. You take that in the balance sheet and you call it the retained earnings, and you put it under the component of what we call owner's equity. Owner's equity, every year you'll see it's split into two. There will be owner's equity, which will be retained earnings over time, over that 5 years that that business has been alive. But there'll be an extra component to say how much of the retained earning did you get in that particular year. Okay. So that's how you link. And I said the balance sheet is the storer of value. The income statement is a creator of value, because the income statement is the one that fills up the balance sheet all the time, or ultimately should be the one that fills up the balance sheet.
So the balance
over time.
The balance sheet actually is the income statement of every year condensed.
Yeah, in fact, that's a very important definition you are putting in.
Yeah, remember,
it's absolutely it's the income statements accumulated, right?
Yes.
Over the 5 year.
Yes.
But it will show you other aspects of your business operating decisions that would not be in the income statement. A typical example would be purchasing of assets. You would not traditionally find that item in your income statement, but you'll find it in your balance sheet. And again, I simplify, the accountants will come in.
I imagine you would find it if the purchasing of those assets happened in that particular year.
No, but it would not be in a income statement.
Oh, I see. Okay.
Yeah, because that would be what we call it's either an investing or financing decision. So typically, when you purchase an asset, it does not come to the income statement. It goes directly to the balance sheet as an asset in a balance sheet. Remember, I said there's 3 components in the balance sheet. There's assets. There's how those assets are funded. It's either through debt or through equity. So if you've bought an asset, it goes straight into the balance sheet. And you need to obviously balance the other two to say, how did you find it? If you got debt, you also put it in a debt so that the balance sheet balances, or through, if you bought it with your own money through owner's equity, you increase that portion of the owner's equity. But that would not typically hit the balance sheet. But without confusing you, there is a way of linking assets to the balance sheet, and you would have heard the term called depreciation. Depreciation is when you devalue the asset over time, just to adjust it for its age and use and its
viability over time.
Over time. But you expense that in the and it gives you a tax benefit in income statement. But I think let's suspend that for now, because it will, and we'll come into it. But I think this is an opportune time now to break down the income statement,
right?
Because we'll get to see what are those linkages
between the income statement
and the balance sheet. But I did say that the most important one is that net income. That when they say the business is destroying value, is when your income statement does not create a surplus. Because guess what? It means you are taking a negative value into the balance sheet. Meaning the balance sheet must be able to carry that. Otherwise, the business becomes insolvent.
In colloquialism, you're losing money.
You're losing money, destroying value.
Give us a call, 011-883-0702. My guest is Andisa Ramavhunga. He's a Group Chief Advisor at Ntiyiso Consulting Group. He is our headmaster today, teaching us a little bit more about the measures or the documenting of value of a business in its two components, the balance sheet and the income statement. We're going to focus now on the income statement and understand the various line items, maybe not in that kind of detail, but in general terms. Then, of course, you can get the detail as we continue. But please give us a call, 011-883-0702. Your thoughts, your insights, your augmentations to this conversations around these two documents, the balance sheet and the income statement. But remember, today we're focusing more on the income statement, and I'd love to hear some of the ways that you've broken these concepts down so that we are able to understand them better. Let's talk about that income statement. So,
and the balance, the income statement, is actually, again, a very simple document. Think of it as a statement of the income, as I've defined it, and how you expense it, right? There's various items that you need to pay in running your business, ultimately that you get to the surplus. And there's two types of costs. Income is one, right? It comes in and income, again, is very simple. And I simplify again. It's the price of what you sell your goods for multiplied by the goods that you've sold for the year. That would be the income that you have. And it's a fairly straightforward thing to calculate.
Sure.
But after that, you have to account for the cost of generating that income. And the first line that you have to think about, or maybe let me not call it the first line, let me call it the first section. So the income statement has 3 sections. And I did not count the income because I'm saying that one is given. I'm talking now
top line.
The costing. Exactly, top line. You should be taking this, right?
So I hang around you too much, bro.
Once you have the top line, you have what I call direct operating cost, or direct others cost of goods sold, but I call it the direct cost associated with delivering a service or selling a goods.
Right.
It's simply, for example, I'll take amagwinya. It's the flowers that you buy, right? It's the yeast that you buy. I would argue the baker you'd put in there because this is the one who's baking amagwinya.
So it's not just the ingredients; it's the putting together of the ingredients, the cost
that produces
the igwinya, right?
Yes.
Okay.
Yeah. So that would be what we call a direct cost. And once you have the top line and you subtract the direct costs, there's what becomes left of it, and voila, it's called gross profit. For those, when you hear the term gross margins or gross profit, basically they are saying from the top line, how much money did you incur in producing your product, and whatever is left is
and selling it.
And no, not selling, not yet. It's just producing a product.
Right.
It's called a gross profit, and we'll come into that because there are other elements. After the gross profit, you've made the product now. It's there, and you can account for it in your balance sheet if you've not sold it. That's why you don't put it up there. Now you need to sell it. So there are costs that are associated with selling it. Things like marketing. In fact, we call them administrative costs. Others call them operating costs.
Right.
So cost of selling would be in the rental for the building would be in the accounting, if you need accountants to come do the books, would be part of those operating costs. Legal costs for incorporation, websites, I know you love that website, would be part of, and those are called administrative costs or operating costs. Once you've subtracted that one, voila, you left what we call an operating profit. So an income statement will show you two types of profit. One is the gross, which tells you how efficient you are in producing your goods, and then which will be the gross profit. And then the next line of profit will be the operating profit, which tells you how efficient you are in selling, in rental, in your administrative expenses, including yourself as business owners. By the way, if you've got other people, salaries will be salaries of supporting staff will be will be coming out of that, and then you get what we call then an operating profit. And then finally you get, and I don't want to complicate it yet. I'll come back and complicate it for you.
You're doing a pretty good job, right?
We're building this knowledge in layers, right? I said there's the direct cost of producing, which is one section of the costs that are incurred. Then you come to the gross profit. And by the way, legislatively, that's how you discount your, because it's important. The people you pay first are people who have done the product, right? The next ones are the ones who are
going to make sure that it's going to go to market, right?
Yeah. So that will be the operating profit. Then comes in the bankers. So if you've borrowed money, and I said, remember, you borrow money, maybe you bought an asset with it. That money or that cost of buying an asset won't show in an income statement. But the interest, if you've borrowed the money, will show in the income statement.
Okay.
Only the interest component, not the capital component. So that you need to pay. Meaning, and this is very important, that if you are not efficient in producing goods, you're not efficient in your operating costs, you have no money to pay your bankers. So that's why those lines are very critical. And by the way, financiers will look at that to say, but how efficient is this guy in producing his goods? How efficient is he in operating his business?
So let me see if I'm with you.
Yeah.
The first line is the income.
Yeah.
But then of course there's expenses in the production of the goods or service.
Yeah.
If you subtract all of that from the income, you then get gross profit.
Yeah.
You then take that gross profit, you subtract all of the things that you require in the getting of the good or service to market. Marketing, sales, administration. Salaries of those people. All of those things are then there. You subtract that expense from the gross profit, and it gives you a operating profit. And then out of the operating profit, you then go and check how much does it cost you in terms of interest for the debt that you have incurred for the assets that make this business run. Right? And if you have been efficient, what is left? What is that bottom line called?
So you'll then pay your bankers, the guys. And then the last guy that you pay is whom we all pay is the taxman. Right. So the taxman will deduct his tax. I think the effective tax rate now for business is about 29%. I stand corrected. Then after that, you have what we call net income. That's the money that you bank. That's the money that then moves into the balance sheet as equity, ultimately.
Or a loss. If you
have a loss, it moves. Remember, a loss means that you needed to find money somewhere. And typically that will come from your cash account, by the way, that's sitting in your balance sheet. Meaning your balance sheet is now starting to fund your income statement. When they say a business is destroying value, this is when you're posting negatives upon negatives year in, year out. Meaning you are requiring more and more of your balance sheet. And your balance sheet, by the way, is reducing by year, every year. And you're eroding that equity component. And exactly. You're eroding the value because
you're losing money.
You're losing money. And
All
you're
right,
reducing the size of your balance sheet.
I want to take some calls. 011-883-0702. My guest is Andisa Ramavhunga. He is the Group Chief Advisor at Ntiyiso Consulting Group. We're getting to understand the income statement, but I think more importantly, the relationship between the balance sheet and the income statement. I do want to get my head around the terminology that you've just used now, that your balance sheet is now servicing your income statement, which in colloquial language would be you losing money.
You're losing money.
I really want to get my head around that, but we've got quite a few calls, and I'd like for us to take those calls. Please call. We'd love to hear your thoughts, your questions, your curiosities, your unsaid, unarticulated questions. Try and make sense of that which you need to understand. I know we don't know what we don't know. I know that, but let's try. Let's try to ask the questions. Nothing here is a stupid questions. Khotso is in Midrand. Good evening to you, Khotso.
Yeah, evening to you, Mr. Masao.
Yes, sir.
Yeah, look, man, to your test, I'm going to request him when you answer me.
Yeah.
You must just try to go a bit slower.
Yeah.
Because I'm not really from that.
No, I hear you, my brother. I hear you 100%. Yeah.
Number one, my question, I want him to deal with the issue which is real and which is there all over and is going to assist the city of Tshwane. Number one, we are dealing with an issue here currently with the city of Tshwane. The city of Tshwane, the mayor is the question which I'm asking is supposed to assist the mayor of Tshwane. We're supposed to know it because I'm told he's a lawyer, but it's ignorant and I'm very worried.
Ask the question, Khotso. Ask the question.
Yeah. My question is that, man, with Tshwane, look, number one, they know they're supposed to pay their employees their increase. That's number one. But they keep on going up and down, dilly-dallying to the CCMA, to the labor court, trying to evade the issue. But what is happening, I've been told that is we call a recurring debt. That debt will never remain. Instead, it will increase and increase and increase. So I want you guys to deal with that issue whereby you find that the employee, the employer, it keeps on dilly-dallying while the debt it keeps on recurring and it remains. Therefore, meaning the mayor is accumulating debt while it's trying to evade the reality. On the very same breath, we must also deal with the issue whereby Tshwane every year they are supposed to they are giving the employees their bonuses on November, but it doesn't want to give them. It claims that the municipality doesn't have money, while at the same time, that money of bonus is not the money of the municipality. It's their money. It's the money which has been deducted over the years. How come the so-called municipality doesn't have money to pay that money? They want to pay that money over some month to say
Khotso in Midrand, much appreciated. I want to say this to you. Please don't feel pressured to answer the question in a partisan way. I really want to hear the principles of what Khotso is raising, which I think is very, very important. But of course, he stands in a particular side of the conversation. Yeah. So help me understand. I think it's a great question.
So, no, it's a great question because it talks exactly to these issues of how you allocate the costs and whether you have got enough surplus to pay costs and don't. And I don't purport to be, because there's again the detail will determine how Tshwane has dealt with the payment of increases and so forth. You and I spoke about labor at some point in time. I think we were talking that time the balance sheet itself, when we were talking about the balance sheet that says, and government is not to say it's different, but in a way, a lot of people believe that because there's national government, then there's money that can come to fund municipalities, which is partly true, but partly not. I say it's partly true because municipalities receive income now, because, and I'll come to say why that income line is important, and it will go to answer Khotso. The income of a municipality is two ways. They get what we call an equitable share, which is a grant from government, and that is calculated as well. It's predetermined, right? So it's steady income based on a number of factors: the indigents that are in there, the services that are not subsidized, and I say subsidized because there's no ratepayer that's paying for them. That's one line of their income. The second line of their income is the services that they charge to us. So every ratepayer would have rates, and part of the rates would be consumption. There'll be bulk purchases in the electricity and water. Multiply that, by the way, by the number of households that are consuming. Then you get the second line of income. But you'll quickly realize that income line is deterministic. So I'm saying there's no outside money, unless obviously government can come and bail out. But in a fiscus like now, I think we've heard as well that the treasury ran out of money at some point in time. But I think what I need to stress, and not so much for government, because I don't speak to them, and I appreciate the offer that let me not talk in a partisan way. But if government was a business, you must understand that you've got what we call the top line, as we've mentioned it. And everything else must be funded by the top line. Meaning that if you have something that the top line can't fund, you go into what we call a deficit, which is a loss. We've just spoken about it now in terms of whether you're creating value or not. So coming back to the Tshwane thing, and I say I don't know the detail. The first thing that I would ask myself is Tshwane itself as a business creating a surplus, right? And if that surplus is being created, is it enough to cover the increases? Because the salaries would have been part and parcel of depending on where you are in the because other people are working as a direct cost. If you think about people who are producing electricity, for example, or the ones who are moving waste, those ones are direct costs. But if you talk about people in IT, marketing, the economic unit, that one would be administrative a unit. Again, it's quite important to understand, are we creating a surplus from a gross point of view? Are we creating a surplus from an operating point of view? And is that surplus big enough to fund the increases that has been pledged? And again, I oversimplify it because I know that with bargaining councils, there have been a history, and I'm not sure whether this is particularly to Tshwane alone, where there's been an agreement that was made, and the employer is expected to honor that agreement. And sometimes maybe the finances are dictating that they can't, and that's why they defer it. And you would reflect that in a balance sheet, by the way, as a liability, because you still have to pay it at some point in time. I mean, you'll keep on carrying it over and over. But the simple question, and you remember you and I spoke about this, to say that a business creates value, and everything else must be funded by that value that it creates. If we create enough surplus, that's the only time we can justify bonuses, we can justify increases, because you need to think of it this way. Because a bonus, I sit as a ratepayer. If this was Johannesburg, I don't pay bonuses of employees, right? That means the income is stagnant. So they might find creative ways of accruing that bonus, and that could typically be improving efficiencies in the revenue value chain. So, for example, you are able to
what about the question that says, but they deduct monies from us every month anyway, so it's not money that comes from either national government or the services. That money is money that is deducted from us anyway. Why would there be no bonus, I think is the question.
And I'm not sure again. I mean, I don't want to purport that if that money was being deducted as a 13th check, for example, or a bonus money, then the management must account to say what happened to that money and why are they. I think they've got every legal right to
ask that question.
That question. But if it hadn't been, and it's part of the bargaining council agreement, it becomes a bit of a difficulty. And that's why in court these are very difficult to settle, because ultimately they're dictated by the realities of the day, right?
And is it fair to see a municipality as a business?
Of course it's a business.
Okay.
Of course, it's a business. It's got a finite client. Every municipality has got a restriction with a very finite number of people. They all consume a certain number of bulk liters of water, certain megawatts of electricity. They all enjoy roads. It's a business. And one of some of the thought leadership that we've always be purporting as a consultancy is that you do need to treat it as a business, because at the end of the day, for you to be able to create a surplus, which you can then again reinvest as a dividend to the citizen, is when you take this business-like mentality. And again, it's about managing costs and increasing revenues.
If I'm to perhaps paraphrase Kotso's question, because I think it's very, very important.
Yeah.
The reason why I didn't want you to get into the debacle of the city itself is because I don't want to cloud the principles, the business principles, with the partisan sort of feelings that may be in that space. But if the business X has got a finite income, whether from government, from national government, or from the services, but that income that it gets does not create a surplus. Then you are saying to me, then it does not, in any business, including a municipality, then there's no justification for an increase.
Absolutely not. Absolutely. Because
an increase or bonuses are totally connected to whether or not there is a surplus.
Absolutely.
So when contracts are signed to say that there will be an increase for workers, is the proviso of if there is a surplus in that contract?
And without getting political, sometimes I always ask myself this question, and I don't know the details of those bargaining agreements, right? But I always ask my question is how much of the strategy, the stuff that we've been talking about, how much of that does influence ultimately what employers settle on at the end of the day? Because you have to take a view, right, that says eventually how much, if for example, and I'll give you a typical example. So we can increase salaries for workers, right? But think about the top line. How do we increase the top line for the municipality, right? Electricity is governed by NESA, so there's no nilly-willy. And I'm sure in the modeling of NESA, they do consider those things. But I'm saying it's not as straightforward. Our workers wanted 9%, and therefore we'll add 9% to electricity, because it's subject again to the NESA process, right, which is I know. So
there's all sorts of components that must work together in order to produce a surplus.
And hence my question that says, how much of those components and understanding do we then ultimately carry to draft a settlement at the end of the day? And I do suspect, and this is my hypothesis, we are in this mess today because there's very little of that, and it's more of circling with sentiment and trying to appraise and appease. And people carrying on debt over and over. They're not the only ones, by the way, in Tswane. If you look at the public sector, they've been carrying this. I think I heard at some point some months ago where the bargaining council were saying that you guys made a determination some 3 years ago, you have not honored it. My sense is that by the time they come to honor that, they find that the realities say otherwise, because the bank accounts are empty.
So the Lion on Twitter says, municipalities can never be a business. And he says, their business is to deliver services. When we say it's a business, we discriminate against those who can't afford. Their cost must be exactly equal to their revenue, says the Lion.
Yeah, look, it's not true. I did say that there's a grant that they get, and the grant is typically to
to deal with those developmental issues.
Developmental issues. So I said there's two sources of income, because ultimately the business needs to be funded. So that's why I call it a business. So the unfunded mandate is done through grants, and there's a number of them. You get others that are capital grants, but don't really make it into the income statement of a municipality. But you get what we call equitable share. I mentioned the concept of indigency. That's why it's quite important, again, for municipalities to keep those things.
People who can't afford.
Who can't afford and so forth. And those are catered in the unfunded mandate. The funded mandate is you and I, ratepayers. From our properties, we need to pay, and that combines the income in total.
I wanted to speak to Charles. I've just lost Charles. I was going to take his calls in a few moments. I suppose the Lion is trying to say that the mandate of municipality is not to make a profit, but to deliver services. It's that whole developmental sort of conversation that we have many, many times. But I imagine that if the same principles of wanting increases and bonuses, which is a fundamentally commercial business imperative, then other business imperatives need to be in operation as well.
So again, I'd like to caution the notion of profit. The concepts are the same. So for us, the profit that the municipality needs to make, or the surplus, is not so much so that they can make a return to government, but it is so that they can fund the historical backlog of underdevelopment. Because it's only through creating a surplus are you then able to fund the historical. I mean, every municipality is underdevelopment. You can look at it everywhere. Electricity penetration, although they've made large streets, there's the unzoned township in terms of what do you call this, the imikuku and all those, and even the backlog of infrastructure, the aging infrastructure.
Informal settlements,
informal settlements. So the notion of profit, again, I'd like to say maybe profit is the wrong word, but let's use the word surplus. It's quite important that they realize the surplus, because otherwise that backlog of underdevelopment will perpetuate in history.
Is that not what Khotso was asking about as recurring debt?
No. So that one is talking about, I guess, the commitments that were made to labor.
To the labor.
Yeah, okay. To say that we are still waiting is 2 or 3 years down the line. Yeah. It's still a debt, and you always carry it as a debt.
So it appears that all of these things are contingent on real practical issues. Is there a surplus?
Yeah.
If there's no surplus, then there's no increase.
Somebody has to fund it. If there's no surplus, somebody has to fund it. The question is then who?
Right.
That's why people would then naturally gravitate towards government. But government has its own pressures, right? And they'll find it more likely than not fund it. But we find ourselves in these issues because I think we are struggling creating the balance between reality and our desires and needs and wants.
How do people get a hold of you? So many people.
Yeah, unfortunately we did not finish the income statement. But
there's got to be part 2, right?
Absolutely. Yeah. But the questions I think are starting to talk to the understanding of income statement and some of the limitations that as I think as a nation we are starting to feel, but they start from understanding the basis and the science and the makeup of what we call an income statement.
How do we get a hold of you?
Yeah, so you can get hold of me at info@ntiyisoconsulting.co.za.
Andisa Ramavhunga is the Group Chief Advisor at Ntiyiso Consulting Group. Thank you very much for joining us. We take the news.
Thank you.